The prevailing market sentiment often swings between two powerful forces, bullish optimism and bearish pessimism. When the majority of traders and investors are overwhelmingly bullish, believing prices will only go up, a dangerous level of complacency sets in. This collective euphoria is rarely a sign of further strength. Instead, it often signals that the market has already priced in all the good news. Those who have already bought are fully invested, leaving little fresh money to push prices higher. The fuel is spent. This is the classic paradox of sentiment. When everyone thinks it's a sure thing to buy, the only direction left for the market is down. The crowd's confidence becomes a top signal. Conversely, when fear dominates and most traders are deeply bearish, convinced that markets will continue to fall, the selling pressure is largely exhausted. Pessimism becomes so widespread that the worst is already reflected in current prices. At that point, potential sellers are gone, and only fearful holders remained. It is in these moments of maximum pessimism that the seeds of the next rally are sown. The very conditions that feel most risky are often the safest entry points for patient capital. This is where contrarian thinking becomes not just profitable, but essential. Acting against the herd requires emotional fortitude, because the pain of buying while everyone else is selling is intense. Yet, history repeatedly shows that the greatest fortunes are built by buying when others are fearful and selling when they are greedy. The contrarian does not blindly disagree with the crowd. They understand that market tops are built on a foundation of hope and consensus, while bottoms are forged in despair and uncertainty. The key is to watch for extreme readings in sentiment indicators, such as the put/call ratio, surveys of investor sentiment, and volatility indices. When these readings hit historic extremes, the probability of a reversal increases dramatically. It is crucial to distinguish between a trend and a sentiment extreme. During a strong uptrend, bullish sentiment can remain elevated for a long time. A contrarian does not short a rising market just because people are optimistic. They wait for the sentiment to become so extreme that it borders on mania. Similarly, in a downtrend, bearish sentiment can persist, and a contrarian waits for capitulation, a moment of sheer panic and hopelessness, before stepping in. The most successful traders use sentiment as a timing tool, not a primary strategy. They align their contrarian bets with technical levels and fundamental valuations. For example, if sentiment is extremely bearish but the market is holding a key support level, that is a powerful setup. If sentiment is euphoric and the market is failing to make new highs, that is a warning signal to reduce risk. The combination of extreme sentiment and a technical turning point is a high probability opportunity. Emotion is the market's most dangerous fuel. Fear and greed drive cycles more reliably than any financial report. Understanding this allows you to detach from your own emotions and view the crowd's behavior as data. When you see a wall of worry, you can assume prices are supported. When you see a wave of complacency, you can prepare for a fall. This shift in perspective transforms market noise into actionable intelligence. Ultimately, being a contrarian is not about being stubborn, it is about being disciplined. The goal is not to always be against the crowd, but to recognize when the crowd has become a source of opportunity. The next major market move often begins where the majority least expects it. By learning to read the sentiment thermometer and acting only at its extremes, you put yourself in a position to buy low when others are panicking and sell high when others are dreaming.